My mom, my dad, and my grandma and grandpa have moved in. They took them out of the nursing home. All four of them are just together in a house.
Watching our videos.
My brother went to get the car from them this weekend. My dad threw the keys out the window.
Hey everybody, JC Parets here, founder of allstarcharts.com, and welcome back to Pardon the Price Action. I am joined, as always, by Steve Strazza. Why don't we get right into it? Crypto, the first Bitcoin ETF could be coming soon. Apparently, the court ruled in favor of Grayscale over the SEC today. Is this the catalyst that the crypto bulls have been waiting for?
Well, it certainly is today, right? We'll have to see if we get some follow through throughout the rest of this week. So far, so good, though. I mean, this is the biggest day for Bitcoin since March. You know, we had some big days this summer. But today, you know, we've outperformed all those days. So you'd have to go back to Q1, even for some of the crypto stocks. For me, it's, you know, we held this support shown here at 25, but there's still work to do, right? There's going to be another test coming up at 30 if and when we get there. And I think that the best opportunities won't be in the altcoins. If you go back to that altcoin index, like they were during the last bull cycle, I think the best opportunities, at least right now, to play a new leg up in Bitcoin are going to be in the stock market.
Yeah, no question. I was impressed at first. So today is Wednesday. What day is it today? Today's Tuesday? Tuesday the 29th. Just as we're recording this in the afternoon, market's still open, and these things are ripping. Marathon's up 30% today. Riot's up like 16, 17%. Strazza makes a good point. You know, a lot of these altcoins, they're not really in strong uptrends. They're in sideways trends, downtrends. You know, nothing clean. I think you have some cleaner opportunities. Maybe better is not so much the right word, but cleaner. These are essentially leveraged bets on the price of Bitcoin. Marathon's like a 4x, and something like a MicroStrategy might be closer to like a 2x, you know, ballpark, just kind of one way to look at it, but really, really interesting. All right, move on to pharma.
All right, we had some big news today. The Biden administration has released a list of 8 pharmaceutical companies that will be forced to negotiate prices with Medicare. Which of these 8 is your favorite?
Well, you know, there's huge bases in the space, as we've talked about a whole bunch. Merck, this goes back to 2000 when they peaked back then. These are 25-year-old bases trying to resolve higher. Merck seems to be the only one. And then, of course, you've got the Eli Lilly and Novo. They are the ones that are doing the for people to get skinnier with the weight loss ones, right? So Novo, Eli Lilly, these things have been absolutely ripping. It's, you know, you can bet against them if you want.
There's a reason they look the way they do. They're both selling the hot drugs right now.
Yeah, I mean, say what you want. You know, you've got the companies, you know, all these sugar companies, Mondelez and all these things that are making a killing, and people are gaining weight. And then these are the companies these are weight loss companies over here. So like from an investing standpoint, the companies that kill the people, the companies that save the people from dying. And like that barbell seems to be working really well, huh?
Yeah, and I think the most important, you know, takeaway about this group of stocks is if you throw up the index itself, this is a hot mess. But when you look beneath the surface, just like in most, you know, groups and sectors and subsectors, there are some real winners. You talked about Eli Lilly and Novo Nordisk, and then we can point to something like Pfizer, on the other hand, which you wouldn't want to touch over the past year or two. So be careful. Look for relative strength beneath the surface. Pick your spots. I think Amgen is really interesting here. Maybe this one moves into a leadership role within healthcare. If we break out of this little range called 265 here, the upper bounds, I like Amgen. I think it joins that group of leaders.
All right, currencies. The dollar is pulling back following 6 consecutive weeks of gains. What's next for the major currency markets?
So I like this chart. This is a consecutive up weeks indicator. And basically the point here, it's simple. I have it marked up to illustrate the fact that you don't tend to get 6 straight up weeks, or God forbid 7 straight up weeks if we close positive at the end of this week on Friday. You don't get that during bear markets typically, right? So if we go back during 2013-14, that big leg higher there, we had 6 straight up weeks. And then during the bull run just a few years back, right? So now we're on our 7th consecutive week. Like I said, we are lower so far this week, but we'll see. And it's just not something that you tend to see in bear markets for the dollar.
I think this is it right here. Below 103, you start breaking down below 101, then things really start looking bad for the United States dollar. I think that's the big one. You start taking out 105, 106 to the upside, maybe a retest of those highs is in order. I mean, based on the weight of the evidence, it's a tough call. Is this a trend line break in the euro, or is this just finding support? Is the Japanese yen going to break down further versus the United States dollar? Our British pound's going to be able to break out above this trend line resistance. UUP, I know you like this one because it's clean. It's an ETF. People looking for a vehicle. I'm not necessarily convinced that the dollar's going to rip. I could very easily see this thing rolling over pretty hard here. So I need to see it.
We're seeing some monster bases in the agricultural commodities complex. What are your favorites?
I like sugar. I mean, look at this base. I mean, you got a lot of these that are just either stuck below overhead supply or, a little bit messy. Sugar seems to be the strong one here. I've always beefed with sugar because, I don't believe that sugar's ticker symbol should be SB. SB should be reserved for soybeans, but that's more of a personal problem on my end. I'm not going to let that stop me from, maybe taking advantage of a higher trend. Sugar looks good at these levels. If it's above 24, I like it long. When you look at the groups overall, here's your equally weighted livestock index. This includes the hogs, feeder cattle, and live cattle back to the former highs. Livestock versus commodities in general, kind of a mess. Here's the grain index, kind of a mess. The softs index, kind of a mess. OJ ripping, which is interesting. Cattle and lean and live cattle, interesting. Corn messy, wheat messy. I like sugar. What about you?
I mean, look, you just ran through it, and I think the point that we could make about the entire group is that you separate it into three subgroups, right? The livestock really stand out, particularly cattle, as the leaders. When you look at grains, it's a little bit messy, and even softs, right? Not ready yet. If you look at those custom index bases, but throw up the cattle contracts. These are the best looking ones, and if you zoom in. No, that's wheat. Yeah, so these are the best looking ones leading these bases. And if you were to zoom in and look at a short-term chart, we're breaking out of like these nice little coil patterns right now as we speak. So I think if you're looking for some opportunities in the commodity space, these have been the leaders, and it looks like they're going to continue to be the leaders. I like cattle, both feeder and live cattle.
All right, risk appetite. Despite the recent corrective action in stocks, risk appetite seems to be holding up just fine. What are the charts saying?
This chart right here says it all, right? Stocks have been pulling back, correcting since mid-July. And look at credit spreads. Still trading at their lows of the year and even last year, right?
As tight as they've been.
Yeah, so that's the bond market's assessment, of markets health right now. And if we look at some of our favorite risk appetite ratios, all of these defensive assets, I look at the utilities relative trend and low volatility relative trend. They're still trading on the lows, right? So all they've done over the past few weeks if stocks have been correcting is kind of chop sideways, these defensive groups. So it's not like investors are positioning themselves for further volatility in the future and, overweighting defensive names in these risk off sectors. No, you're not seeing any evidence of that.
Yeah, no question. You talked about the high yield bonds relative to treasuries. As this line's going up, that means credit spreads are tightening. Right, not widening as there should be when there's evidence of stress in the overall markets. High beta versus low volatility stocks also very highly correlated with equities, holding in just fine. Discretionary versus staples, holding in just fine. So without that rotation into defensive assets like treasuries relative to junk bonds, like low volatility and staples relative to other stocks, without that rotation, I mean, they're not getting defensive. That's very constructive for this market, in my opinion, the fact that those haven't rolled over at all. So that's front and center. Can this get worse? Can the stock market really start falling in the fourth quarter? No question. But I think if they are, I think you're going to start to see these crack, and they haven't yet. So
here's a little game that we like to play called word association. I'm going to throw out a word or a phrase. You're going to tell me the first thing that comes to mind. Work from home.
The dream. is what comes to me. I know that it's cool that people like to work from home and stuff like that. That was always my goal, right? So ever since I was in my early 20s, like that was always something that I wanted to do, was to have the option to work from home, go to an office, travel, go into the city. Great. But to be able to work from home at any time that I wanted was always a goal. And I guess now it's probably more like socially acceptable or whatever. But I didn't care then, so I'm not going to start caring now.
For me, the reason I brought this up is every CEO or CFO or executive has thoughts on this these days, right? It's a popular topic. So the Amazon guy said you can, it's past the time to disagree and commit. And if you can't disagree and commit, I also understand that, but it's probably not going to work out for you at Amazon because we are going back to the office at least 3 days a week. And it's not right for all our teammates to be in 3 days a week and for people to refuse to do so. Look, I think every company is different. Like there's some groups at companies, whether you're like operations or clearing at some sort of a bank, you got to be in the office. Everybody needs to be talking to each other. We even have, a team out in San Diego. They all work together. The analyst team, we work remotely. So I think it depends on the business. But I heard one company do core weeks, which is like you have 25 weeks of the year that everybody has to be there. So I think there's probably a middle ground too.
I think you said it already. It depends on the company. It depends what you guys are doing. In some cases, it doesn't matter. In some cases, you need to be there. In some cases, it can be a combination of both. In other cases, it's impossible, right? Like Louis in New Zealand. We've got Grant in Australia. Alfonso's in Venezuela. You're in Key West today, Vietnam tomorrow. We don't, and it's fine. And we've been doing this for a long time, well before COVID. Which is one of the reasons, in hindsight, if you recall, why we were able to thrive so well during COVID was because we were already doing that. Like it was just another day for us, if you recall. We just kept right on rolling.
Yeah, totally. Listen, it's easy for us to sit back and say, work from home is the way. It's easy. It works for us because it works for what we do. If we were in another business, we might have a totally different perspective. So I think that's important to keep in mind.
Yeah, for sure. I'm not going to go to my dentist's house.
Yeah.
You know what I mean?
Right. Exactly right. All right, let's talk about these tech stocks.
All right. Tech stocks are really rebounding this week following another historic earnings report from NVIDIA. What's next for this group?
I'm going to let you come in and remind everybody about the overhead supply levels. I want to go straight to the relative trends, right? I've been looking at these charts. We've all been looking at these charts forever now. Tech, no matter how you want to look at it, either use the large cap sector spider or NASDAQ 100. Both technology indexes running right back into those dot-com bubble highs from more than 20 years ago. If you zoom in on some of these relative trends, if you want to throw up like QQQ, IWV, we broke out, made new 20-year high. We've gone sideways for about 3 years on a relative basis. So that means no outperformance from tech over the past 3 years. Who knew? If these bases go, I think it would be irresponsible not to anticipate further outperformance and further leadership from tech and growth stocks.
Listen, I think all the potential's there. No question. This could be a bull trap in Apple easily on a relative basis. This could have been a retest of those former highs in technology relative, but let's just remind everybody that technology still stuck below those former highs, right? Semiconductors are still stuck below those former highs. Now, NVIDIA ripped right through those levels and some of the other semiconductors did as well. So there's already precedent to be able for some of these indexes to be able to break out and make new highs. And like Strazza said, on a relative basis, tech is already making new highs. So there's already precedent to ultimately break out on an absolute basis. Just reminding everybody that those are the circumstances that we are still in, despite the strength this week. So I don't think it's going to be quite that simple. I think it's going to continue to be a little bit messy for the foreseeable future, which is perfectly normal for this environment. Some further chop. I don't necessarily think it's going to be a straight shot higher. It could, I suppose, but further chop, with bullish implications, I feel is what it kind of smells like, right?
It seems as though we're making progress in a sense that like the strongest stocks beneath the surface, some of the strongest tech stocks like NVIDIA, are starting to go and take out that overhead supply. Like you said, at the index level, probably take some time. I would imagine, JC, right, that the absolute trends finally get through that overhead supply and break out of resistance. At the same time, the relative trends do. Those two things are likely to happen together around the same time.
Strazza, what's your hot take?
Listen, throw up this AT&T chart. We talked about this one this morning. I'm always paying attention to the analyst activity. AT&T is like up like 2.5% today, which is probably its best day in 10 years. The reason for it, an analyst from Citigroup came out with a bullish note and upgraded the name. You can track the analyst history, and you should, right, when something like this happens, because to me, this is crazy. The stocks are really moving on it. Verizon, too, today. And if you go back and track this guy's track record on the stock, he hasn't had a sell rating on it ever. So he's been buy or hold the whole way down as this massive distribution has been printing over the past 12 years at least. Buy or hold the whole way. Is that really somebody you want to listen to? I don't know.
No, definitely not. I just want to give a shout out to market sentiment. It really comes in handy, and it's such a beautiful supplement to actual price action. I understand that sentiment tends to chase price. I get that. So it's kind of like a little bit lagging in that sense. But, even anecdotal stuff, right? Like we do a lot of quantitative analysis on sentiment and try to bring it all together and aggregate it. But even anecdotally, I would encourage investors to pay attention. Even some of the most bullish crypto people I know, as early as this morning, were already in towel throwing mode. And, I guess nobody knew that these announcements were going to come out, but sentiment was certainly down in the dumps. And I definitely observed that. Also in recent weeks, the sentiment in bonds, everybody just assuming interest rates were going higher. They have not, which is also very interesting. Part of the reason why growth and tech have caught this bid is that interest rates stopped going up and bonds started to rally. I know I'm talking my own book here, being long bonds, but it's working. So it's less about my portfolio and more about the implications of that, right?
Big move today in the bond market. It looks a little bit like a resolution from these short-term coils, right?
Strazza, you guys think I'm crazy sometimes. Like the looks that you give me sometimes and others when I'm like, maybe we should, because I don't want to say that I'm getting good at analyzing sentiment, but I am very aware. I think about it a lot, right? So just remember that.
I didn't disagree about rates coming off of resistance. We had different vehicles, though. You did it through bonds. I did it through tech stocks. They're both working out here.
All right. Well, listen, something for everybody. Everybody, thank you so much for watching. Make sure to give us a like and hit the subscribe button so that you never miss an update. And follow me at allstarcharts on Twitter. And be sure to follow Steve